Trading becomes dangerous the moment a trader steps into the market without clarity, without structure, without an understanding of how the market truly operates. Most people believe losses happen because the market goes against them, but the real reason is far deeper. They enter trades without understanding the foundation required to survive uncertainty. When you don't understand the 4 essential rules that keep a trader aligned with the market's reality, every decision becomes emotional, every reaction becomes impulsive, and every result becomes unpredictable. The market doesn't punish you, it simply exposes your lack of discipline, your lack of structure, and your lack of internal consistency. Many traders convince themselves that they can figure it out while trading, as if the market will generously allow them to experiment without consequences. But the market is a completely neutral environment. It doesn't reward confidence, fear, hope, or belief. It only reflects probabilities. If you step into this environment without understanding the rules that protect you from your own psychological weaknesses, you expose yourself to randomness. This randomness then creates confusion, and confusion leads to emotional trading. Emotional trading leads to losses, and those losses push you into a cycle of revenge trades, hesitation, fear, and self-doubt. The moment you don't understand those 4 rules, you are not trading the market anymore. You are trading your fears, your hopes, and your illusions. You start looking for certainty in a place where certainty does not exist. You start expecting consistency in a place designed around variability. You start acting as if the market owes you something, as if it should move the way you think it should move, instead of learning to accept that your job is to align with what the market is showing you. Traders who don't understand these rules begin to personalize every loss. They take it as a personal attack, a confirmation of failure, or a sign that something is wrong with them. But nothing is wrong with them. What's wrong is that they are trading without structure. Without the 4 rules, there is no framework to process uncertainty. There is no way to stay objective. There is no way to think in probabilities. You begin to see opportunities where none exist and ignore risks that are right in front of you. And slowly you begin to believe that trading is a battle between you and the market, when in reality, the battle is always between you and your own untrained mind. If you don't understand the 4 rules, you cannot trust your decision-making. If you cannot trust your decision-making, hesitation becomes natural. If hesitation becomes natural, you miss opportunities, you chase entries, you exit too early, you hold too long, and you sabotage every position you take. The rules exist to protect you from your emotional inconsistencies, to guide you through uncertainty, and to transform your mindset from a gambler to a professional thinker who acts based on probabilities instead of impulses. The moment you fail to understand them, the market becomes a mirror reflecting all your internal conflicts back at you. This is why when these rules are unclear, incomplete, or ignored, the only wise action is to stop trading immediately. The first and most fundamental principle in trading is understanding the rules that govern your behavior, your decisions, and your perception of the market. Without a clear grasp of these rules, you're not actually participating in the market with intention. You're simply reacting to a stream of information that triggers your hopes, fears, and assumptions. When you don't deeply understand the first rule, which is to know the framework you're operating in, you enter trades with built-in vulnerability. You expose yourself to uncertainty without preparation, and uncertainty becomes a force that manipulates your emotions. Most traders think the market is what creates pressure, but pressure is something that arises internally when you don't know what you're supposed to do, what you're supposed to follow, or how you're supposed to behave in the face of unpredictability. Understanding this rule means recognizing that trading is not about predicting outcomes. It's about following a process that allows you to navigate probabilities. If you haven't defined the rule clearly, your mind will look for external cues to justify every action. You'll search for certainty in the charts, in indicators, in the movement of price, and in random patterns that may or may not mean anything. Without the foundational rule in place, every tick on the chart becomes a source of emotional stimulation. You're pulled toward entering too early or exiting too late because your mind has no anchor, no reference point, no guidance system. The absence of a clearly defined rule leads to inconsistent behavior. You start to trade what you think the market might do rather than trading what you know you should do based on your system. The rule exists to provide structure, and structure is the only thing that stabilizes your psychological state when you're facing uncertainty. Markets move in ways that are often unpredictable. They don't behave according to your expectations. They don't reward your optimism or punish your fear. They simply express a constant flow of buying and selling pressure. If you don't understand the rule, you'll interpret this flow personally. You'll see a loss as a failure or a win as confirmation of skill. But both conclusions are illusions because they're not based on a repeatable framework. They're based on emotional reactions to short-term outcomes. The rule protects you from falling into that trap by giving you a consistent behavioral guideline that is independent of short-term results. When traders skip understanding this rule, they behave like someone driving a car without knowing the meaning of road signs. They can still move forward, but the movement is risky, unpredictable, and dependent on luck. The rule provides context, and context gives meaning to what you see. Without context, you are blind to risks and overly confident in opportunities. You misinterpret normal market noise as meaningful signals and convert uncertainty into self-inflicted pressure. This pressure begins to distort your perception. The chart stops being a neutral representation of price movement and becomes a battlefield between what you want to see and what you fear might happen. The rule also creates boundaries for your behavior. Boundaries are essential because without them, you can justify anything to yourself in the heat of the moment. You can talk yourself into a trade that doesn't fit your plan. You can hold on to a losing position because you feel it might turn around. You can exit a winning trade too early because you're afraid the profit will disappear. When the rule is clearly understood, you operate within a framework that keeps your thinking objective. You act according to criteria rather than impulses. You follow probabilities rather than emotions. Understanding the rule means you no longer approach the market with the illusion that you can control its direction or influence its movement. You accept that your only power lies in how you respond to market information. This acceptance transforms your mindset. Instead of fighting the market, you adapt to it. Instead of resisting uncertainty, you work within it. Instead of avoiding risk, you manage it through rules that define your behavior. This shift is crucial because trading is not a test of intelligence, but a test of internal consistency. The first rule acts as the foundation for all other rules. If you don't understand it, the remaining rules lose meaning. They become concepts rather than tools. To truly internalize the rule, you must recognize that its purpose is to protect you from the psychological traps that markets naturally create. Markets are designed to trigger emotional responses because they constantly fluctuate between gains and losses. Without a firm grasp of your rule, these fluctuations will manipulate your decisions. You'll be attracted to noise, distracted by randomness, and sensitive to every small movement against your position. The rule allows you to create a stable internal environment. When your internal environment is stable, you don't react impulsively. You don't chase trades. You don't panic during drawdowns. You don't fantasize about large wins. You behave according to a structured mindset that is grounded in process rather than outcome. This structure becomes your anchor when the market becomes chaotic. It becomes your reference point when you feel uncertain. It becomes your protection when your emotions try to convince you to act irrationally. Understanding the rule also means understanding your limitations. You're not expected to know what will happen next. You're only expected to follow your rule. This is liberating because it removes the illusion of prediction. You stop trying to be right and start trying to be consistent. Consistency comes from rules, not from intuition. When you follow the rule, you're not trying to win every trade. You are trying to perform every action correctly within your framework. This shift in focus changes your experience of the market from stressful to manageable. It changes your decisions from reactive to deliberate. It changes your results from inconsistent to stable over time. The rule empowers you to trust your system because you trust yourself to follow it. It creates a bridge between your intentions and your actions. It transforms your mindset from one that is driven by emotion to one that is aligned with probabilities. Without this transformation, you will always struggle, not because the market is difficult, but because you are operating without the clarity required to function effectively in uncertainty. When trading lacks structure, every moment in the market becomes an emotional event. The absence of a defined process means you approach each chart movement without a psychological foundation, leaving your mind exposed to the influence of uncertainty. Without structure, the market feels personal, unpredictable, and chaotic because your internal state has nothing stable to anchor itself to. When traders operate without a clear, repeatable system, the mind naturally fills the gaps with fear, hope, and assumptions. These assumptions might temporarily feel like logic, but they are reactions triggered by discomfort, not clarity. Structure is what transforms random market movement into manageable information. Without it, every tick becomes a potential threat or opportunity, and your responses are shaped not by probabilities, but by emotional impulses. The moment your trading decisions are guided by how you feel rather than by what your plan dictates, you are no longer interacting with the market objectively. You start to perceive movement through the filter of your emotional state. If you are afraid, you see danger everywhere. If you are greedy, you see opportunities that don't exist. If you are frustrated, you take trades just to relieve tension. If you are overconfident, you ignore risks that would normally be obvious. This psychological distortion happens automatically. It doesn't require effort. The human mind naturally gravitates toward emotional interpretation when there is no structure directing its focus. Trading without structure is like navigating a storm without a compass. You might move, but you have no control over the direction, and every shift in the wind feels like a crisis. Structure creates consistency, and consistency is the foundation of long-term success. When there is no structure, your behavior changes from trade to trade. You might follow one approach today, another approach tomorrow, and a third approach when you're under stress. You lose the ability to determine whether your results come from your system or from random decisions. You cannot measure your progress because you are not repeating anything consistently. This inconsistency becomes the root of emotional trading. The mind craves certainty, and when you can't find it in your process, you start looking for it in price action. You become hypersensitive to candles, spikes, reversals, indicators, and anything that appears meaningful in the moment. This sensitivity turns normal fluctuations into emotional triggers that push you toward impulsive actions. Trading becomes especially dangerous when there is no boundary between your emotions and your actions. Structure is the boundary. It tells you what you can do, what you cannot do, and what you must wait for. Without this boundary, you become reactive. You enter because the price moved quickly. You exit because you felt uncomfortable. You increase position size to compensate for previous losses. You take trades outside your plan because you fear missing out. You hold losers because you hope they turn around. These behaviors are not flaws, they are natural consequences of trading in a state of emotional vulnerability. When the market stimulates uncertainty and you don't have structure to regulate your response, your behavior becomes erratic. Structure also shapes your perception of risk. Without it, the concept of risk becomes subjective. A trader without structure doesn't manage risk, they negotiate with it. They justify breaking rules, adjusting stops, adding to losing positions, or taking trades that don't fit any criteria. They tell themselves stories to justify behavior that feels comforting in the moment but destructive in the long run. Risk becomes a psychological negotiation rather than a measurable factor. And whenever risk becomes emotional, losses become personal. You start to take every losing trade as a reflection of your ability, intelligence, or potential. Instead of seeing losses as part of probability, you see them as evidence that something is wrong with you. This personal interpretation intensifies emotional pressure and pushes you further away from structure. When traders operate without structure, the market becomes a mirror reflecting their psychological imbalances. If you're impatient, you'll chase trades. If you're fearful, you'll hesitate. If you're hopeful, you'll hold too long. If you're insecure, you'll close winners early. Without structure, the market doesn't reveal truth. It reveals your emotional weaknesses. A structured approach, however, separates your emotions from your actions. It gives you a predefined response to uncertainty so that your feelings don't dictate your behavior. When the market becomes unpredictable, structure becomes your stability. When the market becomes fast, structure slows down your thinking. When the market becomes confusing, structure provides clarity. A trader who relies on structure experiences the market differently. They are not surprised by fluctuation because their system accounts for it. They don't panic during drawdowns because they understand probabilities. They don't rush into trades because their criteria define exactly what qualifies as an opportunity. They don't attach emotional meaning to losses because their focus is on execution, not on results. This mindset is impossible for someone who trades without structure. Without clear rules, every trade carries emotional weight. The outcome of every position becomes a verdict on your worth. This emotional burden drains your psychological energy and pushes you into cycles of self-doubt, frustration, and overcorrection. Structure is not about restricting freedom, it's about creating the freedom to think clearly. When you know exactly what your job is in the market, You stop trying to control the outcome of each trade. You stop forcing your expectations onto price. You stop interpreting random movement as personal attacks. Structure creates a separation between you and the uncertainty of the market. It allows you to observe without reacting, to act without fear, and to adjust without emotional conflict. Without structure, trading is chaos disguised as opportunity. With structure, trading becomes a process driven by probabilities, discipline, and clarity. A lack of structure makes every decision feel urgent. It creates a psychological environment where you feel pressured to act, pressured to fix mistakes, pressured to catch moves, and pressured to avoid losses. This pressure is the enemy of objective thinking. Structure eliminates urgency by defining exactly when you act and when you wait. It transforms time from a threat into a neutral component of the process. It gives you control over your actions even when you have no control over the market. And in trading, controlling your actions is the only control you ever truly have. The market is a neutral environment. It has no intentions, no awareness of your presence, and no emotional connection to your outcomes. It doesn't reward confidence, punish fear, or compensate you for how much you believe you deserve to win. It simply reflects the collective behavior of everyone participating in it. When a trader understands this deeply, their entire relationship with trading shifts. But when this neutrality is misunderstood, the trader interprets price movement as something personal. They feel attacked when the market moves against them, validated when it moves in their favor, and confused when it behaves unexpectedly. These emotional responses do not come from the market. They arise from the trader's mindset. The neutrality of the market is constant, but perception is not. The moment a trader imposes expectations, desires, or fears onto the market, they disconnect from reality and step into a psychological illusion. Accepting the market as neutral forces you to confront the truth that your results depend entirely on your ability to align with what the market is doing rather than what you want it to do. Many traders struggle because they expect the market to respond to their analysis or to reward their conviction. They believe their preparation, time, and effort somehow entitle them to a favorable outcome. But the market does not operate on fairness or logic. It operates on buying and selling pressure. When you internalize this neutrality, you stop taking losses personally. You stop blaming the market for outcomes that come from your decisions. You stop believing that the market is against you or trying to trick you. Instead, you begin to see that every movement is simply information, and how you react to that information determines your performance. This shift in perception is crucial because it removes the emotional weight from trading. The moment you stop attributing intentions to the market, you stop feeling attacked or threatened by its movements. You no longer interpret volatility as danger, but as natural behavior. You no longer see drawdowns as failures, but as statistical outcomes. You no longer see winning trades as validation, but as evidence that you executed your plan correctly. This objectivity is what allows traders to remain calm, consistent, and focused. Without it, every trade becomes an emotional roller coaster. You become sensitive to every fluctuation and interpret random noise as meaningful signals. This sensitivity leads to impulsive decisions, fear-based exits, and hesitation that sabotages your strategy. Understanding the market's neutrality also reveals a deeper truth. The only variable you can control in trading is yourself. You cannot control how price moves, how fast it moves, or when it reverses. You cannot control liquidity, volatility, or the behavior of larger market participants. The illusion of control disappears when you accept the market's neutrality. Instead of fighting uncertainty, you begin to manage it through rules, discipline, and probability-based thinking. This acceptance transforms the way you analyze setups. You no longer look for certainty, you look for favorable odds. You no longer try to predict, you try to align. You no longer react emotionally, you respond methodically. When a trader fails to understand the neutrality of the market, they naturally fall into cognitive biases. They see patterns where none exist. They assume, the market is due for a reversal. They believe a losing streak means a win is coming, or that a series of wins guarantees continued success. These biases are the mind's attempt to create meaning in randomness. But trading has enough real challenges without adding illusions to the mix. A trader who treats the market as neutral doesn't need emotional justification for their actions. They rely on a defined system and let probabilities play out. This mental framework is what separates consistent traders from emotionally driven ones. The market's neutrality frees you from the burden of perfection. Since the market has no expectations of you, you no longer need to prove anything. You no longer need to be right. You only need to follow your rules. You no longer need to predict every move. You only need to execute your plan consistently. This removes the pressure that makes traders force trades or exit prematurely. When you understand neutrality, you stop trying to control outcomes and start managing your behavior. This is the point where trading becomes less about the market and more about your internal structure. By seeing the market as neutral, you stop resisting what it shows you. Resistance to reality is the source of emotional pain in trading. When you want the market to go up, but it keeps going down, you feel frustration because your expectations clash with reality. When the market goes in your favor and then reverses, you feel anger because your hope was challenged. When you hesitate to enter a trade and watch it move without you, you feel regret because your fear overpowered your plan. All of these emotions come from expecting the market to behave according to your internal narrative. But the market is indifferent to your narrative. When you remove expectation and replace it with acceptance, your emotional pain dissolves. You begin to flow with the market rather than fighting against it. A neutral market also reveals the importance of risk management. If the market has no loyalty to your position, then any trade can fail. This reality strengthens your respect for stops, position sizing, and controlled exposure. You no longer assume that good analysis guarantees profit. You understand that even the best setups fail, and that failure is not a reflection of your skill. It is simply a reflection of probability playing out. This mindset allows you to take losses without emotional disruption and wins without overconfidence. It stabilizes your psychological state and creates internal consistency, a critical requirement for long-term success. When you embrace the neutrality of the market, you stop looking for comfort in outcomes. Instead, you find comfort in your process. You gain confidence not from winning streaks, but from your ability to execute correctly. You build discipline not from fear of loss, but from understanding the nature of uncertainty. You develop patience not from forcing calmness, but from accepting that the market will move when it moves, not when you want it to. This acceptance becomes your psychological edge. It protects you from emotional decisions and keeps you grounded in probability-based thinking. A trader who understands neutrality becomes resilient. They can withstand losses without collapsing. They can face uncertainty without panic. They can adapt to changing conditions without resistance. They can continue executing their plan despite temporary discomfort. This resilience comes from realizing that the market owes nothing and promises nothing, but it provides endless opportunity for those who approach it objectively. Lack of clarity in trading creates a mental environment where uncertainty grows stronger than discipline. When you don't have complete clarity about your methods, your rules, or your expectations, the mind begins to operate in a state of confusion. This confusion might not appear immediately. Sometimes it shows up subtly. It starts with small hesitations, tiny doubts, or sudden urges to change your plan in the middle of a trade. But over time, this lack of clarity shapes your entire trading experience. Every decision becomes harder. Every movement on the chart feels heavier. Every outcome, win or loss, carries emotional weight because you're unsure whether your actions align with a structured plan or a momentary impulse. Clarity is the mental lens through which you interpret the market. When that lens is foggy, you no longer see the market as it is. You see it through the distortions of fear, uncertainty, and internal pressure. Without clarity, hesitation becomes a natural psychological reaction. You hesitate not because the setup is bad, but because your mind doesn't have a decisive framework to guide your actions. You keep asking yourself questions in the moment. Should I enter now? Should I wait? Maybe the candle needs to close. Maybe the trend is ending. Maybe it will reverse. These inner dialogues drain your confidence because they remind you that you don't have solid criteria. The lack of clarity forces your brain into a defensive state. The mind hates ambiguity. And when you haven't defined your rules with absolute certainty, the ambiguity of price movement triggers hesitation. This hesitation then spirals into self-doubt, causing you to miss opportunities that your plan should have allowed you to take. In the absence of clarity, fear begins to dominate. Fear isn't always loud. Sometimes it's quiet, subtle, and disguised as caution or logic. But fear becomes the primary driver of decision-making when clarity is missing. Fear makes you exit too early because you're unsure whether the trade will continue. Fear makes you skip high-quality setups because you don't trust your system. Fear makes you widen stops because you're afraid of being wrong. Fear makes you reduce your position size irrationally or increase it recklessly. And the tragic part is that fear doesn't come from the market. It comes from uncertainty within your process. When your mind doesn't know what is supposed to happen next, its default reaction is to protect you, even if that protection sabotages your trading performance. Impulsive decisions also grow out of a lack of clarity. When you aren't sure about what qualifies as a valid entry, you make decisions based on temporary emotions rather than structured logic. You jump into trades because the chart looks right. You chase moves because you fear missing out. You add to losing positions because you want to fix the trade. These impulses arise because the mind seeks relief from discomfort. Clarity removes discomfort, but without it, the discomfort becomes unbearable and the mind forces action to relieve it. Impulsiveness is not a personality flaw. It is a psychological survival mechanism triggered by uncertainty. The more unclear your strategy is, the more your impulses will try to take control. Clarity is what allows a trader to remain stable in an unstable environment. The market constantly shifts, fluctuates, and challenges your expectations. Without clarity, you interpret these fluctuations as threats. But when you have clarity, fluctuations are simply information. You know exactly what part of your system they relate to. You know when to act and when to wait. You know what a valid signal looks like and what invalid conditions look like. Clarity creates a psychological boundary around your decisions. It gives you a filter that separates meaningful information from noise. Without that filter, everything feels important even when it isn't. And the weight of that perceived importance creates unnecessary emotion. Tension. Lack of clarity also destroys consistency. Consistency doesn't come from intelligence, intuition, or luck. It comes from repeatedly performing the same actions under the same conditions. But you cannot repeat what you are unclear about. When your rules are vague, your behavior becomes unpredictable. Some days you follow your plan. Other days you modify it without reason. Some days you take risks you shouldn't. Other days you avoid risks you should accept. This inconsistency creates chaotic results. Wins feel accidental. Losses feel personal. The mind cannot build confidence when the process is unstable. Confidence grows from clarity because clarity creates repeatable patterns of behavior that the mind can trust. Another consequence of lack of clarity is the emotional roller coaster it creates. When you are unclear, emotions rush in to fill the space where logic should be. Each trade becomes a gamble, and with every gamble comes a surge of adrenaline. The moments before entering a trade become stressful because you're unsure whether you're making the right choice. The moments after entering become even more stressful because you're worried about what might happen. The lack of clarity turns trading into a cycle of anxiety, anticipation, fear, relief, and regret. These emotional swings drain your mental energy and make it impossible to maintain discipline. Clarity is also crucial for maintaining objectivity. Without a clear plan, you start analyzing the market emotionally. You see bullish setups when you want to go long and bearish setups when you want to go short. You interpret the chart not based on logic, but based on what you hope or fear. This emotional analysis creates confirmation bias, making you see what you want to see rather than what is actually there. And because the market is constantly moving, it provides endless information you can twist to. Support your emotions. Only clarity can protect you from this psychological trap. Clear rules act as a shield against bias because they define exactly what conditions qualify as valid. Another important aspect is that lack of clarity destroys your ability to trust yourself. When you don't have a clear system, you can't trust your decisions. When you can't trust your decisions, you start relying on random opinions, indicators, predictions, or news. You act based on external influences rather than internal certainty. This dependence weakens your internal stability. You become reactive to everything around you instead of relying on your own structured thinking. Trust comes from clarity because clarity gives you a process that you can rely on even when uncertainty rises. Clarity also determines how you respond to losses. When you are unclear, every loss feels like a painful judgment against your ability. But when you are clear, losses are simply part of the system. Unclear traders take losses emotionally. Clear traders take losses logically. This separation between outcome and emotion is only possible when clarity exists. Without clarity, every losing trade shakes your confidence, and every winning trade feels like a fluke. The emotional instability that emerges from unclear rules creates long-term psychological damage, making trading feel heavier than it should. Clarity is what allows you to think in probabilities instead of predictions. It shifts your mindset from needing to be right to needing to follow your plan. It shifts your focus from outcome to execution. It shifts your emotional reactions from fear to acceptance. Without clarity, probabilities cannot guide you because you don't have fixed criteria to measure them against. Lack of clarity is the silent enemy of every trader. It doesn't show itself directly. It reveals itself through emotional reactions, inconsistent decisions, impulsive actions, and psychological instability. When clarity is absent, the trader becomes a prisoner of their emotions. When clarity is present, the trader becomes aligned with the market's reality. The moment a trader stops respecting boundaries, the entire psychological foundation required for consistency begins to crumble. Boundaries in trading are not restrictions, they are protections. They exist to prevent your emotions, impulses, and assumptions from taking control during moments of uncertainty. When you remove or ignore these boundaries, you open the door for chaos to enter your decision-making process. Boundaries are the invisible lines that separate discipline from impulsiveness, structure from randomness, and professionalism from emotional gambling. Without them, trading stops being a process and becomes a reaction to whatever the market throws at you. You begin to act from instinct rather than logic, from fear rather than clarity, and from hope rather than probability. The consequences of operating without boundaries are subtle at first but destructive over time. One of the most dangerous effects of boundary erosion is the normalization of rule breaking. It begins with one small exception you make for yourself. You maybe widen a stop loss because you're convinced the market will turn. You enter slightly earlier than your system requires because the setup feels right. You increase your position size because you want to recover losses quickly. These small breaks may not feel significant in the moment, and occasionally they might even lead to a favorable outcome. But the market is not rewarding your decision. It is conditioning your mind to believe that breaking rules is acceptable. Once your mind forms that association, the boundary weakens. And once a boundary weakens, emotional decision-making becomes easier and more frequent. Eventually, you start trading without any real structure, even though you might still believe you're following your system. You lose the ability to distinguish between disciplined decisions and emotional reactions. Boundaries also act as psychological guardrails. They prevent you from drifting into dangerous mental territory where fear, frustration, greed, or desperation influence your behavior. When a boundary is clear and firmly respected, your mind doesn't negotiate with itself. There is no inner conflict, no debate, no internal tension. You simply follow what you've predefined. This reduces emotional stress and protects your mental energy. But when boundaries are unclear or flexible, your mind constantly tries to justify bending them. You start arguing with yourself during trades. You question your rules. You seek reasons to do what feels comfortable rather than what is right. This internal negotiation creates psychological exhaustion and increases the probability of impulsive errors. Respecting boundaries also reinforces your identity as a disciplined trader. Your self-image is profoundly influenced by your actions. Each time you follow your boundaries, you strengthen a psychological identity built on consistency and responsibility. But every time you break your boundaries, you reinforce a different identity, one based on randomness, emotional trading, and lack of control. Over time, this identity governs your behavior more than your intentions. You can want to be disciplined, but if your actions consistently violate your boundaries, your mind no longer trusts your intentions. This creates internal conflict between who you want to be and how you actually behave. That conflict is one of the biggest causes of stress and inconsistency in trading. Boundaries also create accountability. When you follow them strictly, you know exactly why a trade succeeded or failed. You can review your performance objectively because your actions are consistent, but without boundaries, there is no accurate way to measure progress. If every trade is taken for different reasons, you cannot determine whether the strategy works or whether your wins and losses are just random. This lack of accountability damages your confidence and prevents you from building a long-term edge. You cannot improve something that is not repeatable, and nothing is repeatable without well-defined boundaries. Another crucial aspect is that boundaries protect you from your emotional extremes. Trading amplifies emotions like fear, greed, frustration, and excitement. Boundaries help regulate these emotional fluctuations by limiting the range of behaviors available to you. When you have clear boundaries, you cannot revenge trade. You cannot over-leverage. You cannot take trades that don't fit your system. You cannot stay in losing positions longer than predetermined. These limitations keep your emotional reactions from becoming destructive actions. Without them, emotions become powerful enough to override logic, especially during times of stress. One emotional decision can spiral into a series of mistakes that wipe out days, weeks, or even months of progress. Boundaries also strengthen patience. When you know exactly what qualifies as a valid setup, you don't feel pressure to take every move the market makes. You're comfortable waiting, observing, and allowing your criteria to be met. This patience is not forced. It comes naturally because the boundaries clearly define what is actionable and what is not. But without boundaries, every movement looks like an opportunity. You start feeling restless when you're not in a trade. You fear missing out. You chase prick. You become addicted to activity rather than focused on quality. Patience dissolves when boundaries are absent because your mind has no structure to guide your restraint. Respecting boundaries also reduces the emotional impact of losses. When you follow your rules and a trade loses, you can accept the outcome because it aligns with your system's probabilities. You understand that losses are part of the process and not a reflection of your abilities. But when you break boundaries and lose, the emotional pain is amplified. The loss feels personal because you know you caused it through a lack of discipline. This creates guilt, frustration, and self-blame, which often lead to even more boundary violations. This cycle is one of the most destructive patterns traders fall into. When boundaries are respected, trading becomes calm, methodical, and consistent. You develop a sense of trust in your own behavior. You no longer feel the need to react emotionally because you know your boundaries will guide your actions. You begin to think in terms of process rather than outcome. You focus on executing correctly rather than on winning. You avoid overtrading because your boundaries filter out low-quality setups. Your psychological state becomes stable, and stability is the foundation of peak performance in trading. Boundaries also shape your relationship with risk. Instead of treating risk as something negotiable, you treat it as a fixed component of your system. This helps prevent catastrophic losses. It ensures that no single trade can damage your account or your confidence. A trader who respects boundaries views risk as a controlled variable, not something influenced by emotion. This maturity in handling risk is what allows traders to survive long enough to become consistently profitable. Every successful trader operates with boundaries, not because the boundaries limit their potential, but because the boundaries protect their potential. They create a mental environment where discipline can thrive, where emotional impulses are contained, and where decisions are made from clarity rather than chaos. Boundaries are the psychological framework that keeps you aligned with the market's reality and aligned with your own long-term goals.